Welcome to Sikich. This is the latest Sikich webinar series we are calling Tax Reform Reset, focusing on recent comprehensive tax legislation passed by Congress. My name is Jim Brandenburg, a tax partner at Sikich, and I will lead our discussion in these webinars. Okay, you've probably heard about tax reform and wondering about this tax reform reset. Let me introduce the series and offer some background. The recent Tax Cut and Jobs Act was signed into law in December of 2017. This legislation brought about comprehensive tax reform in many areas. It was the first major tax reform in over 30 years. There were across-the-board changes impacting businesses both large and small and in all industries. These major changes were ushered in through Congress in a relatively short time frame. When it was signed into law, there was much fanfare, but also some uncertainty for many businesses and taxpayers as they wondered what all these changes meant. Anytime there is tax legislation, especially major changes, it's important for businesses to learn about these changes, find out the effective dates, understand the impact of these changes to the business, and consider if there are any tax planning opportunities. With all these significant changes in the Tax Cut and Jobs Act, many businesses were unsure what to focus on first, second, third, fourth. This might vary from one business to another, but each was asking what changes most critical to analyze and which changes were perhaps less important. What made this process even more challenging was that while the legislation moved rapidly through Congress, any guidance from the IRS was slow to follow. Businesses wanted information to make decisions, but they had to wait. The IRS was tasked with tackling a significant guidance project in dozens of areas in the new tax law, and they did a great job given the complexity and comprehensive nature of the bill. Gradually, the IRS will lead guidance in many areas, and yes, there's still more guidance coming. Okay, so we thought it was important to hit the reset button on tax reform. There were so many changes in a short time frame, much uncertainty, many complexities. We wanted to take a step back and let you see what we've learned so far and what remains. It's important for us to explore tax opportunities in this tax bill, rethink impact of some of the changes, identify several tax pitfalls, and explain some lesser known provisions that perhaps have flown under the radar and you haven't heard much about. It is essential for you to realize that it's not too late to evaluate tax reform and adopt some new strategies. Even if you have done nothing or done very little thus far, you can still benefit from a review of this tax bill and the impact on your business. You can still realize some of the tax savings now, but you need to get started. And that's the focus and emphasis of this Tax Reform Reset webinar series. Okay, as we get started here again, with the Tax Cut and Jobs Act, it was the most comprehensive tax reform bill in over 30 years, and there were 4 stated themes in the bill. 1, to make U.S. companies more competitive with the rest of the world. 2, to grow the U.S. economy and create jobs. 3, to provide middle-class tax relief. And 4, to simplify the tax rules. In our first series, we went through the new tax rates that apply to businesses. We looked at both the C Corporation and the ones for pass-through businesses and the new 20% deduction. In our second webinar, we're going to look at the new changes from tax reform for business deductions. What we're going to look at is some selective changes in business deductions and how they will apply to you and your business. Okay, the first and probably one of the most significant changes is what they refer to as the 100% bonus depreciation. This bonus depreciation applies and actually goes back to 2017 for additions for property acquired and placed in service after September 27, 2017. Now, please note before this, you had 50% bonus depreciation. Now it's up to 100%, and this applies to both new and used property. Previously, bonus depreciation only applied to new property additions. It's important to note that there's no overall dollar limitation for bonus depreciation, so whatever qualifies for it, you're entitled to take. The IRS had issued some final regulations on bonus depreciation this past month here, September 13th of 2019. They also issued some proposed regulations too on other parts of these rules. So be aware that they do have guidance out there now, and many examples for you to follow to see what does qualify and what does not qualify. One thing to note with the bonus depreciation is that, again, it started in 2017, but after 2022, it gets phased down, going from 100% down to 80 in 2023, all the way down to 20% in 2026. Next, with bonus depreciation, one thing to note when it came about was dealing with a specific item called qualified improvement property. This was an area within the tax law that was supposed to qualify for bonus depreciation, but when they drafted the law, they had a drafting error in there. And what's happened with that is the IRS went back and looked at it, and in the guidance, the proposed regulations they issued for any property that went in 2017, they were able to indicate that the bonus depreciation did apply for the 2017 property. However, with the additions for property placed in 2018 and forward, that the IRS was unable to fix that in the regulations. They felt that the change was substantive enough that Congress needed to act, and thus a technical corrections bill would be needed by Congress to make the change so that qualified improvement property could have bonus depreciation. However, this technical corrections remain stuck in Congress and nothing has changed at this point. However, it could be later on this year, so keep an eye on it, and it could be applying for 2018 or perhaps 2019. But if that does change and companies had put qualified improvement property in, they might be able to go back in and file some amended returns and take advantage of that additional bonus depreciation for qualified improvement property. One other change to note deals with the bonus depreciation as it applies to merger and acquisition transactions. One key feature with bonus depreciation, again, as I mentioned before, is that it applies to both new and used property. So in the sale of a business, often these are structured as asset sales. So if a business sells all its assets, the buyer, the acquirer of that business, will be able to take bonus depreciation on all the property that qualifies, all the property except, let's say, for the real estate. They can get bonus depreciation of 100% bonus depreciation, provide a significant benefit in the year that they make the acquisition. Again, this had not been available before, and again, this is having a significant impact on the buying and selling of businesses. Next, another change in the tax reform bill was the Section 179 expensing deduction. Again, this is similar to bonus depreciation, but there are some differences. One thing to note is that the expensing limit was increased up to $1 million, and now indexed for inflation, it's $1,020,000 for 2019. And then there's a phase out of additions, and that's been increased to $2,550,000. Again, the Section 179 was expanded to include property that's used to furnish lodging, and also for non-residential property, any HVAC units, roofs, fire protection, alarm, and security systems can also qualify. And again, that's a change that tax reform brought about. Now, one thing to note, we do have guidance with the bonus depreciation, but there's been no guidance yet from the IRS on Section 179 and these changes. So be aware of that. Hopefully that will come out soon. The effective date, again, this starts in 2018 for the Section 179 expensing, but there's no sunset date. This change is permanent. Okay, so we've got some favorable changes with both the bonus depreciation and Section 179 that we got from tax reform. Here's one that is less favorable, and that's the new limitation on the interest expense deduction. Now, previously, businesses were not limited in the deductibility of interest expense. With the tax reform, however, they put in a limitation limiting the deduction to 30% of what's referred to as adjusted taxable income, or ATI. Now, this is like EBITDA, and it's really taxable income of the business before any depreciation, amortization that it has, any net operating loss, and the actual interest expense deduction itself. Now, please note, starting in 2022, that for this adjusted taxable income, there'll be no adjustment or no add back for depreciation and amortization. That'll make that adjusted taxable income lower and probably have more adjustments or more companies subject to this business interest limitation. Now, if you are subject to this, any disallowed interest will carry forward indefinitely. So even if you're impacted with it, it does carry forward indefinitely, and you could perhaps use it in a future year. This 30% interest limitation applies to both C corporations, again, where the company pays the tax, and also with pass-through businesses, S corporations, and partnerships. That limitation again, applies to both of them at the entity level. And again, with the past two businesses, this calculation is much more complicated. So just be aware that if you have a past due business, this interest limitation is more involved. Okay, as is not uncommon with the tax law, there are a number of exceptions with this new interest expense deduction limitation. First is an overall small business exception. Business with under $25 million in gross receipts is not subject to this limitation. Now, with this exception, however, be aware that how you come up with what's included in that $25 million, there's some guidance on that to go through just to make sure that you qualify with it. So if you think you're a small business, you still need to make sure that you fall within that exception, but they do wanted to provide some relief for small businesses not to be subject to this rule. The next exception relates to real estate businesses. Again, a real estate business can just elect out of the rules. You might think, oh, that's a good idea, just elect out of the rules, you don't have to be subject to them. And that's one opportunity with it. However, the trade-off with it is if you make that election to elect out of the new interest limits, there's no bonus depreciation for the trader business. So that's an important decision to make whether you want to elect out, because you're going to lose out on bonus depreciation with it. So they do have some guidance out on that, and I think more to be provided on how to go about making that election. And then last, if any, for auto dealers, they have an exception for what they call floor plan financing. That also is not subject to the limitation. Again, subject to certain rules with that. So be aware of this new 30% limitation on interest expense deduction. Again, it's already had a impact on some businesses and it will going forward. And note that any debt that a business has, there's no grandfather of that debt. This new limitation started right in 2018 and goes forward. And as noted here, this is a permanent change. It will apply, again, Congress could change this or repeal it, but there's no scheduled sunset date, and it's got a permanent set at this point. Okay, another, I guess, unfavorable change made by Congress in the tax reform deals with business meals and entertainment. In the past, both business meals and entertainment were 50% deductible, with 50% being disallowed. Now, after tax reform, entertainment is no longer deductible. It had been 50%, now zero, starting in 2018. Meals, however, are still generally 50% deductible. Okay, there is some uncertainty when a business meal is combined with entertainment. You know, what is it? Is it going to be partly deductible or not deductible at all? The IRS did provide some guidance in 2018 in this IRS notice, and what they indicated is that the business meal can still be 50% deductible as long as the cost of that meal can be segregated out and separated from the entertainment cost. So if you can document that, 50% of the meal can still be deductible. A couple other items to note with these changes: any company picnics or holiday parties are still most likely 100% deductible. The IRS hasn't issued final guidance on that, but they have indicated that that will likely be the case, that those will be 100% deductible. And last, they did make some other changes related to employee parking. They have new limitations on providing parking for employees, and they have a notice out here, 2018-99, that indicates how to provide those new rules for employee parking. Okay, in addition, what Congress did with the tax reform is they wanted to provide some relief for small businesses. And again, small business in this tax reform was generally determined to be a business with less than $25 million in gross receipts. And again, that's an average of the prior 3 years. And what they wanted to do is provide, one, a tax incentive for businesses that were small businesses, but two, to have less record keeping. So they could make some of these changes, have a tax benefit perhaps, but also have less record keeping involved. So if you go through, we'll go through some of the 4 accounting method changes that they have in a moment. But if you meet these requirements, generally, it's going to be a favorable adjustment for you, and you can take the full impact of that adjustment in the year of change, and that will probably end up with a deduction that's available to the business. Again, that's all allowed in the year that you make the change. You don't have to spread that impact. There is a filing of what they call a Form 3115 or 3115 that you need to go through and file to make any of these changes. The IRS did issue some guidance in this revenue procedure with how to go about doing that. Okay, so let's look at the 4 small accounting method changes that the tax reform provided. Again, these are favorable changes for small business. The first is the ability to use the cash method. A business can use the cash method or change to the cash method, and this could be available even if it purchases, produces, or even has some merchandise with the business. Secondly is for inventories. A small business, again, is not required to account if it makes this change for inventories under normal tax rules. It may use this method of accounting for inventory either to treat the inventories as a non-incidental material supply or if it conforms to the taxpayer's financial statement treatment. So again, they'll be able to write those inventories off much quicker and provide an opportunity for the business. A third change deals with what's called the Uniform Cost Capitalization, or UNICAP. This involved capitalizing certain overhead costs for business, and those had to be capitalized into the cost of the inventory for manufacturer or distributor. A small business, however, makes this change as provided in tax reform, will no longer be subject to the UNICAP rules. So not only will they receive a tax benefit by don't having these costs capitalized anymore, but they have less record keeping involved. And the last change applies to a contractor, long-term, that uses the long-term contract method. It expands the exception for small contracts for them to have to use what is called the percentage of completion method. This limitation had been a $10 million threshold. Now it goes up to $25 million. So a contractor that is under $25 million does not have to use the percentage of completion method, but could switch to, say, the completed contract method or the cash method of accounting. Now, for each of these changes, be aware that there are certain steps and requirements you have to make, but any small business that's less than $25 million should explore one or more of these accounting method changes. Next, there are two other accounting method changes, but perhaps less favorable, that really apply to all businesses, and dealt with two changes that the Congress made, and in fact, they just issued the proposed regulations on this last month. The first deals with, and I put down section 451B, that's the code section that Congress added in tax reform, and it deals with changes made to what they refer to as the all events test. In tax reform, added a requirement that income needed to be recognized for tax purposes no later than when it's recognized for financial statement purposes. There have been situations before when the tax was later. Now they're saying it needs to be recognized no later than it's recognized for financial statement purposes. Again, this starts in 2018. There are several exceptions to it, so you need to look at these rules closely with it and the regulations that were issued. One change that doesn't apply to if you have any installment sales, you don't have to use this new rule, or the long-term contracts that we talked before for a contractor has a different set of rules that can apply and doesn't have to deal with this new change. Again, to comply with this new change for businesses, they may result in another change of accounting method and file that form 3115 that I mentioned earlier. So just be aware of that. The other change is related close to it. It's section 451C, and this deals with advance payments that a business receives. If they receive these advance payments, tax reform indicates that some of that income is going to get recognized in the year that those advance payments are received based on how much they receive or report for book purposes, but the balance of those advance payments have to be recognized in the year following the year of receipt, or in year two, if you will. And this really put into the statute an old IRS Rev Proc 2004-34, and it really put that into the statute. So any businesses that have, on an accrual basis, that get some advance payments for their goods or services need to take a look at this and see how this is going to affect them. Again, there were proposed regulations issued on this in early September this year. And again, it may end up with the filing of a form 3115 for the company. Okay, the last item I want to just talk about, it's not really a deduction for businesses, but it's a tax credit. And again, this is a favorable change that applied, and it's a new item that came about, and it's a new tax credit. It's for employer paid family and medical leave. And it provides a tax credits for employers that provide at least 2 weeks of paid leave per year for full-time employees and a corresponding amount for part-time employees. Now, please note it only applies to employees earning less than $72,000 a year and that have worked with the company for at least a year. And the credit is as long as the company pays at least 50% of the employee's normal wages, they can get 12.5% tax credit on the wages they paid during this leave time. If they pay their full wages, they're going to get up to a 25% tax credit for the employee. A couple things with it: you need to have a written plan that talks about this paid family leave. Again, family and medical leave is something that federal and state law requires employers to have, but they don't have to pay the employees for that. What this credit does is it provides an incentive for companies. If they do pay for that leave, they can get this tax credit. So again, it rewards employers who pay employees for this leave, for family and medical leave. It's available for both C corporations, again, companies that pay that tax, and pass-through entities. That credit's determined at the entity level and passes through to the owners of the business. One thing to know with it, that they do have some guidance out there, more is expected with it, but it only applies for the 2018 and 2019 tax years. Hopefully Congress will extend this because a number of businesses are just learning about this, trying to get the rules into place so they can capture the cost to take advantage of the credit, and hopefully they will extend it beyond 2019. Again, in today's competitive labor market, companies are always trying to find ways to attract or to retain their workforce and to try to distinguish themselves to other companies. They may want to consider this benefit, or if they're already offering this benefit, offering a paid leave, then just to document the costs they have with it, to get the plan in place and capture those costs so they can take advantage of this credit. So again, this covers, again, some of the business tax deductions that were offered in the tax reform with it. Again, it was a selected overview of it. There are other items in it, but we thought this was a good overview of some of the both favorable and some of the unfavorable provisions applying to businesses. Again, if you have any specific questions, please contact your Sikich tax advisor. We can go through this with it. And we thought this was a helpful overview so you can look at tax reform reset here and see where you can take advantage of some of these tax deductions that were offered and minimize the impact of those that were less favorable. Thank you very much.